Hi everyone, welcome back to the Value Investor Show. Today I want to walk you through everything you need to know about United Health Group for this year. The stock has been selling off like crazy the last week, and many investors are asking, is this still a buy or is it time to sell and move on? So in this video, I'll cover the negatives from the latest quarterly results earlier last week, the positives from the results, the important analyst questions and answers, a deep dive into the company's 2025 outlook, and my intrinsic value estimate and final thoughts for the company. So United Health Group reported earnings on July 29th. Revenues were up 13% year on year. They just beat estimates as United Health Group reported 111.6 billion. EPS was 4.08, missing estimates by 8%, but most significantly, they were down 40% year on year. Now, in terms of guidance, EPS for 2025 was revised down to $16 a share versus earlier guidance of 26.25 when Andrew Whitty was CEO earlier this year. So overall, revenue growth was encouraging, but to be fair, profitability and margins were hit much harder than expected. After reviewing the earnings report and listening to the call, there's some main challenges that I think investors should know, and these are the key headwinds for the rest of the year and in fact for 2025 and beyond. Firstly, there will be slower revenue growth ahead. UNH expects increased membership declines into both level funded and self-funded categories due to higher medical cost trends. UNH is consolidating essentially parts of its business and shifting focus from revenue growth to margin improvement. The second thing is that value-based practices are struggling. Prior to 2021, they were operating at 8% margin. Compared to 2022 and 2023, they were operating at 2% margin, and 2024 onwards, they are operating at negative margins. And this is in fact because of two main issues: the underpricing issue and the elevated care intensity issue. Thirdly, the Medicare funding is having cuts. Funding pullbacks will weigh heavily through to 2026. And fourthly, the DOJ investigation is still ongoing. There's still ongoing scrutiny, which is going to hurt sentiment and investor confidence in the future. So as I said, guys, historically, UNH has been growing revenue rapidly from roughly 100 billion in 2010, roughly 15 years ago, to over 4 times that amount to roughly 400 billion this year. But growth, as you can see, is slowing down. Margins are collapsing due to mispriced products and high costs. So in fact, net profit margins are hit badly. Historically, profit margins have been at the 4 to 6% level. However, in 2025 onwards, we might see a sub 3% level, which is probably the lowest it has been in nearly 2 decades. And this collapse in profitability, I think, is probably the key reason for the stock sell-off. But with that being said, I do think that the leadership has a plan to move forward. On the earnings call, the leadership highlighted several major issues, and I want to dive more into the costs, the actual costs that the company is expected to incur over the coming years. Firstly, they said that the pricing assumptions were well short of actual medical costs. In fact, for 2025, their outlook, their view reflects a 6.5 billion more in medical costs than anticipated in the initial outlook, which is probably why we have seen such a drastic drop in their EPS estimate for the year. In terms of the V28, and for those of you that don't know, V28 is the formula that the government uses to calculate how much insurers like UNH get paid to cover Medicare Advantage patients. UNH is facing 11 billion in costs over 3 years because of V28, which is 2 billion higher than originally anticipated earlier this year, and 7 billion of which is expected to hit through in 2025. Margins will remain low, and the leadership thinks that margins will return to higher percentage points from 2027 onwards. Moreover, increased care activity across individual and group Medicare Advantage will continue through the year, which as well will lower margins, and the company will have to pay settlements up to 500 million this year. So many of these issues were known under the previous leaderships, but essentially what happened is it was kicked down the road, and now the new CEO, Stephen Hemsley, is forced to face them head on, which is a great gateway to the positive, because despite the challenges, there are some things to flag out that I think is positioned positioning the company to bounce back. Firstly, UNH will add 300,000 new value-based care patients expected in 2025. Of course, this is lower than the 650,000 previously mentioned earlier this year, but while it's smaller, that's because they're carefully choosing business segments that will improve margins and not just top line growth. Secondly, they flagged that by 2026, they expect 1 billion further in cost reductions through efficiency and operational improvements. There is a focus on pricing discipline, better forecasting, and operational improvements. And lastly, they are accelerating investments in the consumer experience and core modernization with investments in AI to be realized from 2027 onwards. So my view is that leadership is being transparent. They are prioritizing long-term margins over short-term revenue growth, and they are taking the right steps to fix the business problems that they have across all aspects of the business. Now, I have listened through the whole almost 1.5 hour earnings call. I've read through the Q&A session, I've studied it, and I want to walk you through what I think were the most important questions and answers from that call so that you don't have to. Number one, the analyst asked about the repricing impact on Optum Health. The company said it expects stable margins in 2025 via benefit reductions and cost savings. They also asked about incremental costs and investments and ROI, and the leadership said Optum Insights and AI could lead to good contributions, but they will pay off in 2027 onwards. Moreover, there was a question around the management process review, and the CEO said they returned to a more intensive monthly management review of business performance and strengthening underwriting process. So overall, the company has taken drastic steps to improve their operational efficiencies, to reduce costs, to improve margins, and also to improve the way they have been doing business from a bottom-up and top-down approach. Moreover, there was a question around the margin outlook beyond 2026, because as we said, the company expects margins to improve from 2026 onwards, and the company said the following. Firstly, the margins will improve, but it will take time. It won't be a 1 year miracle. It will take time to stabilize, to improve consistently, but they do expect margins to improve at this level at some point in the future. And for example, for Optum Health, they expect the margins to be at 6 to 8%. For value-based care, they expect margins to reach 5%. And for services, they could see margins to improve up to 10% in the future. But with that being said, the current EPS impact is that the year 5+ cohorts are expected to hit 8% margins, but the 2024 onward cohorts are loss generating, so they have negative margins. So overall, the leadership has a clear long-term plan to restore margins, but it will take time, guys. I do think that this is a longer-term opportunity. It's not an opportunity that will probably return capital gains in the next year. It could take more than 2 years to get back even remotely close to where it was in 2023. So it will take time for sure. But based on the updated assumptions, based on what has been said, I have put together an intrinsic valuation for the company with margin of safety, and this is my base case only. And based on what has been said, I have estimated revenue, EPS, and free cash flow growth of 10 to 11%. And note that in my analysis, I have already accounted 2025 cost pressures and revenue growth already. So with that being said, the growth is estimated from 2026 onwards, which essentially under my current assumptions, net income is expected to reach 2023 levels in 2030, which I think is a base case scenario. And with a 10% discount rate and 50% margin of safety, my average intrinsic value with margin of safety is $205, and my 2030 price target is $500 to $700. Now, my overall thoughts is that over the last week, I have been buying a bit more shares at the 260 levels. Since then, the stock has fallen off a bit more, but at the moment, I'm sitting at the 283 average price. I'm not looking to add anytime soon because I'm happy with my investment right now, but I will be watching closely over the coming months. My view is that UNH faces huge short-term challenges, higher costs, weaker margins, funding cuts, and regulatory scrutiny. However, I believe in the company, I believe in healthcare, and I believe in the current leadership. The leadership is being transparent, it's being disciplined, it's being focused on fixing the issues, and I expect a recovery, but it will take time. It will take 2 to 3 years, I think, not months. And in the meantime, I'm happy to get a 3% dividend and buybacks. And, I'm not expecting a bounce back this year, but with most negatives already priced in, I do think that this is a long-term buy and hold. Thank you so much for watching. If you would like to support the channel, drop your questions in the comments. Thank you for all the donations. Every donation, however small, goes a very long way. You can find the link below. Follow me on X for daily updates. Please subscribe to the channel. It helps a lot. If you are about to donate, please leave your X or your YouTube channel name so that I can shout you out next video, and I'll see you next time.